The following is a presentation of TFNN. Live at TFNN, the Power Trading Hour, with your host, David White. Now, the author of The Path of Least Resistance and the Tech Insider, David White.
And welcome to a bipolar market. Yes, we've got something going on here, and I'm here to call the play-by-play on the Power Trading Hour every day between 2 and 3 at the headquarters of technical trading and investing. It is TFNN.com. We're up 11 points, now 12 points on the S&P cash, 2.2 billion shares. We're going to be watching this volume before the end of the day. If you've been listening to this program pretty much all the last 10 days, it looked like the options were pointing to an expiration on Friday at 1,800 on the S&P cash. I also said that in 10, 12 years, it had never been so narrow. It is giving the best prediction of an expiration, at least statistically, that I've ever seen. And maybe it goes a little higher than that, but at the moment, we'll watch the options toward the end of the day. But it is going to be that 1,800 on the S&P cash. So probably we'll be watching a little bit more about how things are going on out here. But of course, anytime we start talking about Ben Bernanke, we need to start doing his theme. There he is. He's out on the catwalk. He's doing his little dance on the catwalk. It's Ben. There he is. He's out there for his beauty theme, and he's done a little spin. In about 25 minutes, he will be back on stage. 22 minutes now, back on stage, and he'll be taking questions. And normally, he's been extremely good about deflecting anything that actually means anything. I haven't really seen the market move except once, what was it, about 6 months ago, on anything he actually said. But we'll see what happens. I still think that we're going to be stuck at 1,800 come Friday. I also think that we're going to close somewhere at the end of the year between 1,820, 1,830. And that's going to be just a slow melt up, maybe a couple of points every day into the end of the year. And at that point, we're probably going to have the least amount of shorts anytime this year in the marketplace. And guess what? That opens up a wonderful opportunity for us if the markets continue weak into the end of the year. One of the reasons we've been talking about a scenario where everybody comes in and starts selling at the beginning of the year was the 1999-2000 January 3rd high. What had happened was that they had passed a change in the way that the taxes were going to be charged. And I think what it was, 25% down to 15% on capital gains. So there wasn't a soul that was willing to give up 12 or 15% on their gains to sell it in about 45 days. So no one was selling anything the last 45 days of 1999. The markets went up. You saw a tremendous rise in prices, and I think just about everybody around TFNN was short Qualcomm at that time. Split adjusted now doesn't do it any good because it was like $1,000. But even split adjusted back in those days, it went from $195 down to $130 in 5 trading days. And a lot of other tigers out here were watching that thing every day because the last 30 days it had absolutely no volume all the way up. We knew that we had a house of cards. So as we watch this market today, I'm waiting and a little bit hoping that we get this slow, no volume move up to about 1,830 on the S&P cash right into the end of the year. And for a short or someone that wants to go short, a market like this is actually painful because every day you just think, I'm going to go short, I'm going to go short, I'm going to go short. And the right thing normally to do is what someone taught me early on in shorting, and that is the 3-day rule, or the rule of three, actually. You're going to be early 3 days, 3 weeks, 3 months, or 3 years. In this case, I think we've had 3 years where this market has gone up on light volume. So we may be at the very extremes of markets, up 11 points on the S&P cash, 2.3 billion shares, just a little over it right now. So I'm sitting here and kind of doing the play-by-play as I watch a lot of the stocks and how they are reacting. We talked a great deal about the VIX yesterday. I talked about the VIX crush. There is the rush for premiums getting in the S&P cash. There is the crush. Right now I'm seeing the leveraged VIX out here off 8.5%. That is the UVXY. I suspect that you're going to have that as a really good opportunity starting at the end of the year. We've got some other stocks out here that are leaving the S&P. Those are probably the only ones that are not going to see a lot of love in the last few weeks. Now, what would make me bearish on today's news? A close below 1782. We've been playing with that level for a while, but it looks as in the intraday charts that's where we need to be watching this market. And of course, not uncommon to see the first move in the S&P up, the second move back down, and then the last move back up. And the bears and bulls will be fighting for a while today. So I'm going to let the dust settle and see if there's any trade between now and the end of the year. I'm not betting on it. And as we go and normally start off the show with history, we'll go back to 1899, rocked by the news of heavy casualties in the battle against the rebels in the Philippines. The Dow Jones Industrial Average suffers its fifth worst daily percentage loss of all time, plunging 8.7%. or 5.57 points. Hard to think that you could get almost a 9% move with 5.5 points, but it did in 1899. Closed the day at 58.27. So we've had big moves on this day. Maybe we'll have another big one before the end of the day. Now just up 8 points on the S&P cash, but we shall see. I still think we've got a lack of volume over the next few days, and that's going to be enough to get rid of the weakest hands. Those hands are always the weakest from the shorts. That is, they are more likely to trade at a faster rate than someone that trades long by a factor of 3. Lots of studies in stocks and commodities. I think that's where I saw it over the years. Showing that the shorts, for the most part, don't have a lot of backbone. When trades start going against them, they are very quick to cover their short positions, which is the right thing to do. But at the same time, it's a lot harder to sell a market off when people won't sell. And a lot more people are willing to ride stocks down. But what can you say? 2.35 billion shares. Just seeing if we actually get enough volume to get an escape velocity here. And of course, when you look at the ES chart, it looks more like a heartbeat than any other thing that it may. 7.5 points up. But we'll get more into the show. I think it's starting to actually slow down a little bit. Today, as we came into the day, Ford came out, had weakness in the third world, especially in Latin America. The F-50 may be delayed, mostly because it's going to be incorporating aluminum. So maybe us traders out here, let's get a quick quote on Ford. It's off a buck. It's down off a $1.20, which is 7%. One of the bigger moves on Ford. I thought that we'd hit a high on this show and talked about it 2 or 3 weeks ago. Mostly the problem I saw was the big runs in General Motors and stirring the pot for the rest of them had been the return for subprime loans from General Motors, pushing a lot of low-ended cars back onto the market, probably pushed by the government itself. And trying to get out of the last shares of General Motors. Now that they are, maybe we're going to see traditional lending practices come back, but I think it pushed a lot of business over into Ford and some of the other ones. But a lot of weakness in the third world, especially Latin America. But 7% on a big mover like that, always interesting. What else do we have out here for today? Lennar beat earnings on above consensus. LEN current quotes up $1.57 at 36.77, up 4.4%. Of course, they had some pretty good news, and the rates for new houses also doing well out this morning. Jabil Circuits, this is a little bit more interesting. JBL. Okay, Jabil Circuits off $4, which is almost 21%. In their contracts, they cannot make a comment on how any of the companies they do business with are doing. Jabil makes and assembles a lot of equipment, some for Apple, some for Cisco. And the thought today is that maybe Apple's down a little bit and under pressure because of it. But also Cisco is thought to have the biggest problem with shipping new equipment. When we look at Apple real quick, AAPL off $11, kind of on the same news, thinking that maybe the Roach theory. We'll try to do a look at the options during the break. But if I remember right, this thing wants to close somewhere around 550 or 560 based on the options. So probably not a lot of downside in this one either. So we'll be keeping a close eye on all these. And during the break, I'll have a little bit of opportunity to go back. But, of course, going to be starting the Fed question and answers in about 10 minutes. And we'll find out what he has to say here. This is Bernanke's last dance on the catwalk. On the catwalk. He's going to do his little spin on the catwalk. Anyway, he's going to be out there straightening his stuff, as he always does. And we'll be, unless he has something really specific to say, looks to me like tapering is game on. They're going to be talking about doing this before Yellen takes the stage next month, to make sure it looks like a continuation of policy and not something where she just came in and steered the Fed committee in one particular way. So looks like there's going to be continuation. I'm sure he checked with her. They always have a huge desire for consensus. But almost always the Fed has always been late pulling the trigger back, and probably see some problems coming in the coming months because of it. Anyway, we'll be back in a minute. Give me a call, 877-927-6648.
With over 3 decades of trading experience, Andy Hecht brings a tremendous amount of knowledge and expertise to each weekly issue of his newsletter, the Technomental Commodity Report. The Technomental Commodity Report gives you Andy's unique technomental analysis of the commodities market, a combination of technicals and fundamental analysis which he has developed and perfected over his many years of trading. The Technomental Commodity Report is only $49 a month, and right now you can get a full month-long trial subscription while paying absolutely nothing. See for yourself the kind of weekly report Andy delivers to his subscribers every Thursday morning. You'll receive specific stock, ETF, and option trades based on Andy's analysis, so no futures account is required. For all the details and to start your month-long free trial to the Technomental Commodity Report, visit TFNN.com today.
With the launch of Tiger TV, TFNN has brought our programming to the next level. With Tiger TV, you can gain access to each host's charts and computer screens as they host their daily stock program. Whether it's Tom O'Brien, Steve Rhodes, Basil Chapman, David White, Larry Pesavento, Andy Hecht, Victor Jones, or Terrell Martin, you can catch all of our technicians hosting their programs live and archived on Tiger TV for your viewing pleasure 24 hours a day, 7 days a week. If you haven't checked out Tiger TV, then visit TFNN.com and see what you're missing.
You take a hands-on approach to managing your investment strategy. You're always looking for the next trading opportunity to magnify your perspective. Direction Shares connects sophisticated traders with a powerful array of ETFs from a wide range of asset classes. The markets may go up and down, and you want tools for both sides of the trade. Discover how we can help at DirectionShares.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction Shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction Shares. To obtain a prospectus or summary prospectus, please contact Direction Shares at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors employing dynamic strategies. Investors in the fund should understand the consequences of seeking daily investment results, understand the risk of shorting, and intend to actively monitor and manage their investments. Distributor Foreside Fund Services, LLC. Wouldn't it be great if you could get a red light, green light indicator that gives you signals on 25 different futures contracts? Now you can with Taz Signal Box. This red light, green light market profile system dynamically updates 24 hours a day and provides you with important trend and trade signals on 9 different commodities, 9 different indices, and 8 different currencies. Right now, you can receive a 2-week free trial to Taz Signal Box. For all the details and to find out how the Signal Box works, visit the front page of TFNN.com. TFNN is excited about our new software charting program, The Art of Timing the Trade Charts. In collaboration with Tom O'Brien and using his best-selling book, The Art of Timing the Trade, Your Ultimate Trading Mastery System, David White has programmed an outstanding piece of software that will complement any trader's methodology. Using this first-of-its-kind program, The Art of Timing the Trade Charts allows you to scan thousands of stocks for Fibonacci formation setups, including Gartley's, ABC's, butterflies, and much more. The Art of Timing the Trade Charts is designed to help you when scouring the markets for stocks just beginning to form the trading patterns that many investors spend days, weeks, or even months searching to find. And right now, we're offering licenses available at only $79 a month. We are so confident that you're going to love this new charting software that will even give you a 30-day unconditional money-back guarantee. Don't miss out on this incredible new piece of software. Get your copy of The Art of Timing the Trade Charts today by visiting TFNN.com.
Dave takes your phone calls now. Toll free at 1-877-927-6648. Internationally at 727-445-1044.
Anyway, as we were talking, Apple off kind of a little bit hard. 2 things on Apple, and we'll get into the other one in a minute. But part of that was a Jabil circuit today guiding down. General Mills missed GIS on earnings and revenue. Apple, of course, dropped the ball. I'd been talking about a while how hard it was going to be for Apple to break into China. Everybody kept on telling everybody 6 months ago how they were going to come in and take over streaming audio. Then for the last couple of months, it's all how they were going to get in and take over the phone business in China. None of this stuff has come to pass because the reason they hadn't done it already was it was so hard. On the case of streaming audio to make money. On the case of China, they particularly don't want foreigners in their markets, and for the most part, they're going to try to keep them out. They have their own companies making smartphones with Android operating systems. No reason to let Tim Cook in here and steal any of the thunder, but they always want a tit for tat. And the question is, just how much are they going to make Apple? No, I can't say that. I can't say that either. All the things I want to say, I can't say. Anyway, it would be extremely painful, if you know what I mean, for what they're going to demand Apple do And a lot of times it is give up some level of technology to them. Maybe it is look in your operating system under the guise of the NSA has made all these phones able to be cracked. Somehow, some other technology that they want or need, maybe in PCs, to let them have. But there's always a tit for tat when dealing with the Chi-Coms, and my guess is it's going to be incredibly painful for them. And Vixie was aware of that, too. She did bark in the background. Anyway, Bitcoin. If you hadn't been watching Bitcoin and you're watching everything going on here in the markets, one of the problems that Bitcoin had was the Chinese basically upped the problem they had and got rid of their largest Bitcoin exchange, BTC China, announced that it was no longer accept deposits in local currency. Not only was off 50%, Bitcoin was absolutely decimated. Every other cryptocurrency that's come along trying to be Bitcoin was off extremely hard overnight. Litecoin, if you've heard of it, 40%, Peercoin 35%, Namecoin 40%, Quark off 44%, ProtoShares 44%, WorldCoin off 42%. That was earlier this morning at about 9 o'clock when I looked. But these cryptocurrencies are going to be quite volatile, and I don't know how you get into a business where the price of what you have changes 50% overnight, and many times overnight. Again, the digital tulips of our time. So what else do we have out here? IPOs. AMC came out on the NYSE today. It priced on the low end at $18, opened up about $21. Stay away from this. I don't have any idea why anyone would be buying a movie theater chain, especially with most of the movies not doing that well. And there's just not a whole lot of upside to this market. Maybe if they start making movies that the masses want to see again. But at the moment, they tend to make formulated movies, and that is making only kids who want to get out of their house and away from their parents show up at the theaters. Although there are several new movies coming out, for the most part, they're not enough anymore to support companies like Coinstar and even I'm almost thinking that we're going to be seeing some weakness in Netflix because of the dearth of decent movies coming out. There's a handful, probably about 5 coming out for this fall, always the season where a lot of people are watching these movies. But I can't see any redeeming value in AMC, although I know a lot of people that worked in that corporation for my days in Lenexa. But I can't see as a company any kind of usable growth that would ever be in this thing. Maybe they'll make dividends or something, but doesn't make a lot of interest to me on why they're trying to do that. Yeah, everybody's making theaters at home. Everybody's streaming everything, but the 3D thing just hasn't worked, and IMAX is good, but I think we've seen the limit of what we can do with that. Anyway, we'll be back in a moment. Hopefully we'll have the Bernanke audio live here if I can get it worked out. Be back in a second.
If you're an active trader looking for that extra edge when it comes to trading and investments, then now is a great time to get a 2-week free trial to Tom O'Brien's daily market letter, Market Insights. Tom O'Brien's daily newsletter, Market Insights, comes out every market day at around 9:30 a.m. and provides Tom's daily commentary on the broad market, including the Dow, NASDAQ, and S&P, plus specific trade recommendations. There's even an update published most afternoons to keep you informed about the day's market activity. He'll give you the entry price, price target, and stop price of each stock and option trade. With Market Insights, there's nothing left to guessing. For all the details and to get your 2-week free trial to Market Insights started today, visit TFNN.com.
No matter where you listen to TFNN programming, we want you to know you can always access your favorite shows on demand through TFNN.com. TFNN airs live programming every market day from 9 a.m. till 6 p.m. Eastern, and you can view each program by accessing Tiger TV through our homepage. We even have an easy link for all mobile devices, including iPhones and iPads, located at the top right-hand corner of the TFNN homepage. You can use your smartphone to view Tiger TV, but if you don't have a mobile connection that can keep up with streaming live video, then you can simply visit TFNN.mobi in the browser of your smartphone for live streaming audio of all of our programs. The mission of TFNN is to educate our audience directly and interactively through our interactive website and radio call and talk shows. TFNN is able to teach all levels of investors the technical skills needed to trade in today's marketplace. In order to get the best information possible, TFNN has assembled the most respected financial minds in the country to provide the most current news and comprehensive advice available. TFNN.com. Educating investors.
Has the current market volatility continued to stop you out of trades when the market spikes against you? Now is the perfect time to open up an account with Nadex. Nadex, the North American Derivatives Exchange, is a brand new, completely regulated Chicago-based exchange, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their completely free trading platform, which also features real-time charts and full customization capability. One of the advantages of trading with Nadex in volatile markets is that your risk is always capped and you have the ability of keeping your trades open even when the market spikes against you. Nadex is completely brand new with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's Nadex.com. Or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors. Daryl Martin coined the phrase diagnostic trading, and we're happy to announce that his diagnostic box spread analyzer has finally been released. The Diagnostic Box Spread Analyzer helps you easily identify the best box spreads on Nadex in seconds, plus you receive access to the diagnostic deviation levels, as well as step-by-step training videos teaching you how to trade Nadex spreads so you can quickly master the mechanics of this simple yet powerful trading instrument. By pulling live data from the Nadex exchange, the Diagnostic Box Spread Analyzer does all the math for you, calculating risk, reward potential, distance to break even for both outright spreads and spreads used to hedge the underlying market. Visit the front page of TFNN.com today to get your 2-week free trial to Daryl Martin's Diagnostic Box Spread Analyzer and gain access to the valuable information it can provide when trading the Nadex box spreads.
This segment is brought to you by Harmony Gold. For more information, just click the Harmony Gold banner on the front page of TFNN.com.
Well, Ben's speaking right now. We're going to go right to him for just a little bit and see if he has anything intelligent to say.
Until the outlook for the labor market had improved substantially in a context of price stability. Since then, we've seen meaningful cumulative progress in the labor market. For example, since we began the current purchase program, the economy has added about 2.9 million jobs, and the unemployment rate has fallen by more than a percentage point to 7%. For comparison, when we started the program, many forecasters saw the unemployment rate remaining near 8% throughout 2014. Recent economic indicators have increased our confidence that the job market gains will continue. For example, non-farm payrolls have recently been increasing at a pace of about 200,000 jobs per month, and the unemployment rate has fallen by 0.6 of a percentage point since June. With fiscal restraint likely diminishing and with signs that household spending is picking up, we expect economic growth to be strong enough to support further job gains. Further, FOMC participants now see the risks around their forecasts of growth and unemployment as having become more nearly balanced rather than tilted in an unfavorable direction. Forecasters saw the unemployment rate remaining near 8% throughout 2014. Recent economic indicators have increased our confidence that the job market gains will continue. For example, non-farm payrolls have recently been increasing at a pace of about 200,000 jobs per month, and the unemployment rate has fallen by 0.6 of a percentage point since June. With fiscal restraint likely diminishing and with signs that household spending is picking up, we expect economic growth to be strong enough to support further job gains. Further, FOMC participants now see the risks around their forecasts of growth and unemployment as having become more nearly balanced rather than tilted in an unfavorable direction as they were at the inception of the asset purchase program. As you know, we've been purchasing $85 billion per month in longer-term Treasury and agency mortgage-backed securities. Starting in January, we will be purchasing $75 billion of securities a month, reducing purchases of Treasuries and mortgage-backed securities by $5 billion. Our sizable and still increasing holdings will continue to put downward pressure on longer-term interest rates, support mortgage markets, and make financial conditions more accommodative, which in turn should promote further progress in the labor market and help move inflation back toward the committee's objective of 2%. Our modest reduction in the pace of asset purchases reflects the committee's belief that progress towards its economic objectives will be sustained. If the incoming data broadly support the committee's outlook for employment and inflation, we will likely reduce the pace of securities purchases in further measured steps at future meetings. Of course, continued progress is by no means certain. Consequently, future adjustments to the pace of asset purchases will be deliberate and dependent on incoming information. Asset purchases remain a useful tool that we are prepared to deploy as needed to meet our objectives. With unemployment still well above its longer-run normal rate, which committee participants currently estimate to be between 5.2 and 5.8%, and with inflation continuing to run below the committee's 2% longer-term objective, highly accommodative monetary policy remains appropriate. To emphasize its commitment to provide a high level of monetary accommodation for as long as needed, the FOMC today also enhanced its forward guidance. For the past year, the committee has said that the current low target range for the federal funds rate would be appropriate at least as long as the unemployment rate remained above 6.5%. Inflation was projected to be no more than half a percentage point above our 2% longer run goal, and longer-term inflation expectations remained well anchored. We have emphasized that these numbers are thresholds, not triggers, meaning that crossing a threshold would not lead automatically to an increase in the federal funds rate, but would indicate only that it was appropriate for the committee to consider whether the broader economic outlook justified such an increase. With many FOMC participants now projecting that the 6.5% unemployment threshold will be reached by the end of 2014, the committee decided to provide additional information about how it expects its policies to evolve after the threshold is crossed. Based on its assessment of current conditions in the outlook, which is informed by a range of indicators, including measures of labor market conditions, financial conditions, and inflation pressures, the committee now anticipates it will likely be appropriate to maintain the current federal funds rate target well past the time that the unemployment rate declines to below 6.5%, especially if projected inflation continues to run below its 2% goal. In part, this expectation reflects our assessment, based on a comprehensive set of indicators, that there will still be a substantial amount of slack in the labor market when the unemployment rate falls to 6.5%. This continuing job market slack imposes heavy costs on the unemployed and the underemployed and their families and reduces our nation's productive capacity, warranting our ongoing highly accommodative policy. But as the last phrase of the enhanced guidance underscores, the prospects for inflation provide another reason to keep policy accommodative. The committee is determined to avoid inflation that is too low as well as inflation that is too high, and it anticipates keeping rates low at least until it sees inflation clearly moving back toward its 2% objective. Our forward guidance is reflected in committee participants' latest projections for the path of the federal funds rate. Although the central tendency of the projected unemployment rate for the fourth quarter of next year encompasses 6.5%, 15 of 17 FOMC participants do not expect a rate increase before 2015. Most see our target for the federal funds rate as rising only modestly in 2015, while 3 do not see an increase until 2016. For all participants, the median projection for the federal funds rate is 75 basis points at the end of 2015 and 1.75% at the end of 2016. In summary, reflecting cumulative progress and an improved outlook for the job market, the committee decided today to modestly reduce the monthly pace at which it is adding to the longer-term securities on its balance sheet. If incoming information supports the committee's expectation of further progress towards its objectives, the committee is likely to reduce the pace of monthly purchases in further measured steps in future meetings. However, the process will be deliberate and data dependent. Asset purchases are not on a preset course. The FOMC also provided additional guidance on future short-term interest rates, stating that it expects to maintain a federal funds target in its current near-zero range well past the time that the unemployment rate falls below 6.5%, especially if projected inflation continues to run below 2%. The Federal Reserve's enhanced guidance about its policy intentions and its substantial and still increasing holdings of longer-term securities will ensure that monetary policy remains highly accommodative, consistent with the pursuit of its mandated objectives of maximum employment and price stability. Thank you. I'll be glad to take your questions.
Thank you, Elon Moy at the Washington Post. Today was the first reduction in asset purchases, and you just said that future reductions will likely occur in measured steps, but are not on a predetermined course. Can you tell us any more about the framework that you all plan to use to determine the size and the timing of those reductions? And previously you had said that you expect the program to end altogether by the middle of next year. Is that still a likely scenario?
Well, as I said, the steps that we take will be data dependent. If we're making progress in terms of inflation and continued job gains, and I imagine we'll continue to do probably at each meeting a measured reduction, that would take us to late in the year, certainly not by the middle of the year. If the economy slows for some reason or we are disappointed in the outcomes, we could skip a meeting or two. On the other side, if things really pick up, then of course we could go a bit faster. But my expectation is for similar moderate steps going forward throughout most of 2014.
Steve Leisman, CNBC, Mr. Chairman, thank you. When you say similar moderate steps going forward, is $10 billion an increment that people should anticipate? And is equal amounts of mortgage-backed securities and treasuries also what one should anticipate? Finally, when you say well past the unemployment rate of 6.5%, why not pick a number? Why say well past? Thank you.
Sure. On the first issue of $10 billion, again, we say we're going to take further modest steps subsequently, so that would be the general range. But again, I want to emphasize that we are going to be data dependent. We could stop purchases if the economy disappoints. We could pick them up somewhat if the economy is stronger. In terms of MBS versus treasuries, we discussed that issue. I think that the general sense of the committee was that equal reductions or approximately equal reductions was the simpler way to do this. It obviously doesn't make a great deal of difference in the end to how much we hold. So that was going to be our strategy. On the issue of another number, the unemployment rate, let's talk first about the labor market condition. The unemployment rate is a good indicator of the labor market. It's probably the best single indicator that we have. And so we were comfortable setting a 6.5% unemployment rate as the point at which we would begin to look at a more broad set of labor market indicators. However, precisely because we don't want to look just at the unemployment rate, we want to, once we get to 6.5, we want to look at hiring, quits, vacancies, participation, long-term unemployment, et cetera, wages. We couldn't put it in terms of another unemployment rate level specifically. So I expect there will be some time past the 6.5% before all of the other variables that we're looking at will line up in a way that will give us confidence that the labor market is strong enough to withstand the beginning of increases in rates. The SEP, the Survey of Economic Projections, which were distributed, obviously that's individual assessments and not the committee's collective view, but nevertheless it gives you some sense of current expectations about the length of time. The SEP shows that the 6.5% is expected by a large number of people to be reached about the end of next year, end of 2014. And then the first rate increases, according to the so-called DOTS chart, take place near the end of 2015. So that's the order of magnitude, I think, that people are currently expecting. But again, I emphasize that it will depend on our being persuaded that across a broad range of indicators, the labor market is sufficiently strong that we can begin to withdraw accommodation.
John?
John Hilsenrath from the Wall Street Journal. Mr. Chairman, as you well know, the Fed is going through a transition next month. Can you talk about the role that Janet Yellen played in formulating the policy that's being laid out today, and what kind of consistency the public can expect as we go into her tenure, assuming she's confirmed, with the program that you're laying out today? Will it carry on under her leadership?
Yes, it will. I have always consulted closely with Janet, even well before she was named by the president, and I consulted closely with her on these decisions as well, and she fully supports what we did today.
Hey,
Robin Harding from the Financial Times. Mr. Chairman, your inflation forecasts never get back to 2% in the time horizon that you cover here out to 2016. Given that, why should we believe the Fed has a symmetric inflation target? And in particular, why should we believe you're following an optimal policy, optimal control policy, as you've said in the past, given that that would imply inflation going a bit above target at some point? Thank you.
Well, again, these are individual estimates, big standard errors implicitly around them, and so on. We do think that inflation will gradually move back to 2%, and we allow for the possibility, as you know, in our guidance that it could go as high as 2.5%. Even though inflation has been quite low in 2013, let me give you the case for why inflation might rise. First, there are some special factors, such as healthcare costs and some other things that have been unusually low and might be reversed. Secondly, if you look at the fundamentals for inflation, including inflation expectations, whether measured by financial markets or surveys, if you look at growth, which we now anticipate will be picking up both in the U.S. and internationally, if you look at wages, which have been growing at 2%, and a little bit higher, according to many indicators. All of these things suggest that inflation will gradually pick up. But what I tried to emphasize in my opening remarks, and which is clear in our statement, is that we take this very seriously. It's not easy to. Inflation cannot be picked up and moved where you want it. It requires, obviously, some luck and some good policy. But we are very committed to making sure that inflation does not stay too low. And we are continuing to monitor that very carefully and to take whatever action is necessary to achieve that.
And on optimal control?
Well, even under optimal control, it would take a while for inflation. Inflation is can be quite inertial, can take quite a time to move, and the responsiveness of inflation to increasing economic activity is quite low. And particularly given an environment where we have falling oil prices and other factors that are contributing downward forces on inflation, it's difficult to get inflation to move quickly to target. But we are, again, committed to doing what's necessary to get inflation back to target over the.
We'll be back in just a moment.
Patterns, profits, and peace of mind.
Are you looking for a precision edge in the market? Something that can stack the odds in your favor? Then look into Larry Pesavento's trading newsletter.
Patterns, profits, and peace of mind.
In each weekly issue, Larry explains what's going to happen in the markets based on the pattern he sees developing and gives you actionable trade ideas based on those patterns. Plus, you'll get his detailed analysis on a variety of markets and sectors, including stocks, treasury bonds, the gold market, oil, the dollar, the Forex market, and more. You'll get access to all the patterns Larry is seeing in the markets, plus the Astro Harmonics and powerful Bradley stock market model that Larry utilizes for less than $5 a day. An extremely potent combination that will give you the edge you've been looking for. Try Patterns, Profits, and Peace of Mind absolutely free for 2 full weeks. That's an $85 value. Yours free when you register right now.
Get Larry's Patterns, Profits, and Peace of Mind.
And get the edge you've been looking for.
Have you subscribed to the Gold Report yet? On Wednesday, August 14th and Thursday, August 15th, Tom O'Brien advised his Gold Report subscribers to close out 6 of their 9 open positions, all winning trades ranging from a 10.69% profit to an incredible 48% profit in just one equity. Tom O'Brien brings an incredible wealth of knowledge and experience to the gold market and the equities within the industry. That's almost 12 years since this powerful newsletter first began. And right now, you can get a 30-day free trial to the Gold Report by visiting TFNN.com. Make sure you're a subscriber as this volatile gold market makes its way back into positive territory after declining all the way from $1,900 to under $1,200 an ounce in only 2 years. Get your 30-day free trial today by visiting TFNN.com.
David White's newsletter, The Technology Insider, is focused like a laser on finding the next big things in technology. If you had invested only $10,000 in Microsoft in 1986, you'd have been a millionaire by 2000. Disruptive technology like Microsoft's is the key to these massive long-term profits, and the Tech Insider is the vehicle from TFNN to capitalize on these opportunities. This is the go-to newsletter that identifies, monitors, and profits on mostly little-known cutting-edge companies with great long-term prospects. David's experience is as an inventor of Emmy-winning animation products for TV and Hollywood that propelled a company public. Match that with 14 years as a full-time trader, and he's uniquely qualified to guide you through the light-speed world of ever-evolving high-tech. If you're ready to ride the next big technology bull market for less than $40 per month, log on to TFNN.com and get your 2-week free trial to the Technology Insider. Get in on the ground floor of the next big thing today.
I believe that we're all here to contribute something unique, and that deep within us lies a special gift, a special talent, our own bit of genius, just waiting to be tapped into. When it comes to trading and investing, I can help you tap into yours. Hi, I'm Steve Rhodes with TFNN, and on Thursday, December 19th, I'm hosting a 1-hour workshop where I'll share with you my most incredible discovery yet, the Rhodes Momentum Indicator. I developed this tool with one outcome in mind, to do what nobody else considered possible, to put the power of the most advanced indicator, scanner, and trading strategy in the hands of people just like you and me. I can promise you this, you'll never look at a chart the same way again. This event is available to all subscribers to my newsletter service, Mastering Probability, which for the holidays is available free for the next 30 days. No charge whatsoever to new subscribers and no obligation on your part. Please join me by going to the homepage at TFNN.com to sign up for this once-in-a-lifetime opportunity.
This segment is brought to you by TFNN. Test drive all the newsletters for free at TFNN.com.
And as we're back here in the market, hopefully I've got the right volume level here. It seems like I don't have a lot coming back in my headphones after this break. But, we've got the market up, 16 points, 2.9 billion shares are closing in on it. Going to be a decent volume day as we get up here. But everything shows, and still does, as I looked at options over the break, that we are going to be trying to expire around 1,800 on the S&P cash. And I don't think there's a whole lot that's going to change any of that. We've got pretty much at decent support levels at 4,000 on the NASDAQ. We've got pretty much a 1782 low that I don't think is going to be broken before the end of the year. I'd say 90% chance we close higher than that, and I think that there's probably a better than 70% chance we close higher than 1820 at the end of the year. We need a major reversal before the end of the day. Listening to Mr. Bernanke, there were a couple of things that he said that were important. Basically, that they're going to continue tapering, that it's going to be moderate over many, many months, over many meetings. There may be some meetings where they don't taper. So we're going to have a very volatile year next year. He's making some comments right now on the bonds that are getting those things to move a little bit. One of the things that could crack this market is that 10-year going above 3%. A lot of people are using that as the benchmark. Also looking at the dollar, looks like maybe we've had the washout there. The dollar index printing off at $80.25. And the shiny yellow metal continues to meander down, up only $3.40 now, $3 at 12.33. Keep on thinking we're going to get that surprise move down and the shakeout. My guess is that it could be even worse than I had originally thought. Thought maybe we were going to have one day down that was like $50, maybe $75 in a day, and get a reversal, and that would be the low in gold. It looks to me much more like it may take $100 now to get everybody out. Just continue coming in here and buying at this 12.30, 12.25 level means that there are going to be a lot of people that can be chased out of the futures market in the near future with a big gap down. And what you don't want to see, especially in any kind of commodity, is it hanging around down at the lows for more than a few days. We've had basically 3 decent bounces out of gold, each one being lower, each one coming back to the support level. And, it's probably a 50-50 chance here, but I'm going to wait for the break in the market before I commit any of my troops, my George Washingtons, into going after gold. We had a few other things I wanted to get into before the end of the show. Maybe I can get to them before then. One of the things I think Bernanke had been looking at was that the world market cap had gotten to new highs. We are almost $1 trillion more than when the crash happened back in 2007, 2008. And industrial production is above that 2007, 2008 level. There's not a lot of cover for him to continue pushing money down the line and or being frugal when it comes to cuts, other than we're probably going to see this $5-10 billion number all the way through next year on every Fed meeting. And so 85 billion down to 75 billion, and it'll be 65 billion, 50 billion. Getting rid of the morphine IV drip of easy money. We'll see you tomorrow. Same bat channel, same bat time. Remember, sell when you can, not when you have to.
Since 1984, Basil Chapman has been using the Chapman Wave methodology to advise traders of his expert market opinion. While originally hand-drawing charts from the late 1970s into the 1980s, Basil noticed that prices under most circumstances virtually always had a certain number of legs to the upside before declining sharply. Later, Basil found that computer software, which included the standard market technical indicators, enhanced the degree of accuracy in calling price turns, as well as market trend calls. Thus was born the Chapman Wave sequence. Using the Chapman Wave methodology along with other indicators, Basil Chapman advises his subscribers of his expert market opinion each market day with his opening call newsletter. Right now, you can get a 2-week free trial to the opening call, Basil's daily trading newsletter, by visiting the front page of TFNN.com. Cancel at any time during that trial and pay absolutely nothing. Get your 2-week free trial to Basil's newsletter, The Opening Call, today by visiting TFNN.com.